All right, what is going on, people? Today we're talking about Goldman Sachs trying to become Blackstone. For those of you that don't know who Blackstone are, they're one of the world's largest and best private equity firms. So Goldman is moving towards becoming a private equity firm, and we're going to talk about why and the reasons for that. So with that, let's get straight into today's video. All right, first and foremost, what you need to know, you've got all these different divisions at Goldman's: the investment banking division, the sales and trading division, asset management division, private wealth division, and lots of other back office divisions, but those are the front office, right? And then you've got this small division that used to be a front office division on its own called the MBD, the Merchant Banking Division. This is a history lesson for those of you that aren't aware. Merchant Banking Division, it started in the 80s or 90s, and it used to basically sit on its own. It had, of all the divisions, Goldman Sachs sales and trading had like 7,000 employees, IBD had maybe 5,000 or 6,000 employees, asset management 4,000 employees, thousands of employees across these divisions. The Merchant Banking Division, if I'm correct, had less than 1,000 employees, maybe 500-600, maybe 200, something like that. It was really small. But this division was making almost as much money as the global markets, sales and trading division, asset management division, so on and so forth. Not as much as the investment banking division, because they were Goldman's bread and butter. They've been doing it the longest, they're the best in the field, etc. But the merchant banking division was making as much revenue as some of the front office divisions, with about a tenth or, an eighth of the number of employees. As a result, the revenue per employee was super high, and these employees were loaded, basically. They were making as much money, if not more, than people in the investment banking division, sales and trading division, etc. The partners in the merchant banking division, the people at the top, multimillionaires easily, if not double digit, some maybe triple digit millionaires that had been in the game a very long time. Now, what did the MBD, the merchant banking division, do? Or what do? They're still around, but they're basically going into asset management. Do you want to ditch your current email provider, whether it's Gmail or someone else, for a more secure email? The truth is, big tech email providers make money by scanning your emails and collecting your data so it can target you with ads. ProtonMail believes your emails belong to you. They've got an easy switch migration tool which lets you transfer your emails, contacts, and calendars and more from Gmail to a secure inbox which only you have access to. Best of all, you can get started with ProtonMail for free, or you can upgrade to a paid plan for even more advanced features by using the first link in the video description below. Now let's get back to the video. The merchant banking division invested in private equity, private credit. So private equity, investing in private companies that are already established and making them grow and selling them for a profit, improving them, basically. Private equity. Private credit. So credit is like loans and debt, basically, providing financing to companies that need it. They do senior loans, they do mezzanine loans, so in the middle, a mix between equity and debt. That's probably a whole nother video. They do infrastructure investments. So infrastructure is like roads, tolls, bridges, so on and so forth, global infrastructure. They invest in projects that improve and build these tolls, bridges, etc., and then they make money off of that. And then they do real estate as well. So private equity, private credit, infrastructure, and real estate. They've been investing in these areas for a good few decades, and they make a ton of money. When you think of traditional private equity firms, you've got Blackstone, you've got KKR, so many others. They do all of this type of investing that I've just mentioned. And so Goldman's in-house private equity firm or arm was the merchant banking division. It did private equity, private credit, infrastructure, and real estate. Now this arm, it's kind of being consumed by or going under the umbrella of where asset management sits at Goldman. So the investment management division, typically or previously, it had asset management, it had private banking, and it had the consumer business. Now within asset management, the merchant bank is going in there. They're two completely separate businesses, but they're being tied together as part of the CEO's strategy to make Goldman more like Blackstone. Now, why do they want to be more like Blackstone? My last video, I mentioned why Goldman are struggling. The sales and trading business and the investment banking business, in the down market, they don't make as much money. They're very cyclical in nature because deal flow dries up and market volatility dries up, so it's harder to make money. Whereas asset management and private banking, they have a constant stream of revenue. Regardless whether we're in a bull market or a bear market, these businesses still make money and shareholders love that. And so the private equity business, they make a ton of money. They're going under the asset management business. And so Goldman wants to kind of grow that and make sure that people know that this business exists and it offers a huge revenue stream for Goldman's as an investment bank. That's attractive to investors. When you are investing in private equity funds and businesses, you can expect to make larger returns compared to traditional investing that is more short term. And the reason for that is because when you're investing in illiquid investments, long-term investments where your money is tied up for longer, the return potential or the return expectations are going to be higher. So that's why when you invest in private equity, in real estate, in infrastructure, you can expect returns of 10, 15, 20% plus, or even venture capital, 20, 30, 40, 50% plus, growth equity that is, versus, you know, investing in bonds and fixed income, etc. So it makes sense for Goldman to focus on trying to become or create a mini Blackstone within the Goldman Sachs brand or within the Goldman Sachs Global Investment Bank, because the return potential is there. They already do the work. They just need to, you know, make more people aware of it and have that bow to their arrow that says, you know, we've got this business that will provide stable, constant growing income, even when the sales and trading and investment banking divisions are struggling. And also it's less cyclical in nature. Now, obviously it's Goldman Sachs. They've got brand equity. They've got brand power. So it's going to be easy for them to kind of grow a mini Blackstone. We'll see what happens over the next few months to the end of the year. But I definitely think it makes sense to kind of focus on this business and grow it. This new move is going to annoy a lot of their clients. So Goldman does a lot of work from its investment banking division and sales and trading division with private equity firms. So now it's kind of going to be stepping on their toes, although it's already been doing so for a long period of time, but now it's going to be more public about it. And so it's going to be an interesting space to watch. Anyway, with that, I don't want to drag on too long. Hope you enjoyed this video. Thanks for making it to the end, and I will see you in the next one. Peace.